All right, guys, I've calmed down since our last reaction video that we just did. Tim, is this one going out before or after?
Well,
this one's going out before Tesla.
All right, so
edit the heck out of the last one.
If you're new to this channel, I am guaranteeing you that you need to subscribe because you're going to see an epic reaction video from me about Tesla. I threw the pen at the camera. Oh, there we go. I have to fix the pen. This reaction video, I don't watch videos. Tim sends me these and says, hey, let's comment, let's react. Sometimes they're good, sometimes they're bad. This is about housing correction. I've never seen this video. Mo, have you seen this video?
No, I have not. I don't even know who this is.
All right, so we're going to look at it. It's Fast Money on CNBC. Just for the record, I think CNBC is, you don't listen to the commentary on CNBC. They're too short-term oriented. We preach long-term. We don't care about the results day to day. We care about the long run. So let's watch this video on the 20% housing correction. When was this video posted?
2 weeks ago.
2 weeks ago.
This is out from the Dallas Federal Reserve. Central bank officials warning a 20% drop in the housing market in terms of prices is in the cards. And if that happens, that could put a real dent and real personal consumption expenditure. So is a major housing correction unavoidable at this point? Let's ask Peter Bookvar, Chief Investment Officer with Bleakley Financial Group and a CNBC contributor. We use the term bleak on purpose since you're from Bleakley. Peter, you agree with this, that this is a possibility. Do you see that 15 to 20% number that they sort of threw out there as a scenario, a likely one?
Well, in certain markets, for sure, particularly the hot ones. And just to give perspective, over the last 2 years, home prices are up 40%. If you look at the time frame between 2013 and 2022, home prices went up more than the 1998 through the 2007 housing bubble. So it's an extraordinary rise. And now you have 7% mortgage rates, which are 15-year highs. So it has all the ingredients to see
What was that, Mo?
I don't look at this as a bad thing. I mean, if what goes up must come down, and I don't think it's going to be just a drastic fall.
Well, I don't believe that what goes up must come down. It's just a matter of how it goes up.
Well, this went up. This shouldn't have gone up these high. You know what I mean? Like there's no way that housing should have gone where it went.
So
houses should double in price.
My reputation is being this like, oh, things are terrible. I haven't been that way about housing, and here's why. I use this analogy all the time. 1975, the average interest rate was 9%. In 1985, the average interest rate was 13.5% or something like that. In 1975, the median home was $32,000, and then in 1985, it was like $83,200. Right. So you see a 50% increase in interest rates with almost tripling of value of homes. Why? Inflation. You know, my fiance got her mortgage less than 2 years ago at 2.625%, and now her same mortgage would be 7.5%. Is that a problem? 100% that is a problem. However, you couple that with inflation. And remember, inflation is the cost of how much it costs to build, because home prices are based on, shouldn't say home prices. It's based on supply and demand. Let's say, for example, inflation was insane and a home that cost $300,000 last year now costs $10 million, but wages have all skyrocketed. Are home prices going down? No, absolutely not. They're going to skyrocket.
Right.
Okay. Now, to his point, though, the hottest markets that saw the biggest gains, yes, we could expect that because even, I don't care where you are, home prices should go up with income, right? So if the income in an area, let's say we have Isolation Island, and it's the only economy in the world, and income's going up 10% per year, you can't have home prices go up more than 10% a year, and they probably won't go up less than 10% a year for long periods of time. Okay? That's the whole key here, because people spend what they make, what can they afford to spend on a home. And there's a combination in the short run of a lot of things. Cost to build, interest rate costs, things like that, age of the community. There's a supply and demand of the people in the community. There's so many factors. I'm not thoroughly convinced. And here's another piece of evidence, Mo. Some of the home builders in the last few quarters have reported a big drop in home sales.
Right. But
they haven't reported a huge drop in the average price of a home sold.
Right.
That tells me, like, Mo, you renovated your house last year, 2 years. When did you renovate your house?
18 months ago.
I renovated his same house. I owned it about 18 months before that. And my cost to renovate was way less than his cost. Yeah. And I'm now renovating a new house for myself. And my cost to renovate is going to be way higher than his cost. Yeah. So all these things together. Now, is he wrong to say like interest rates could drive home prices 20 in some markets, especially the hot ones? Yeah, maybe.
I also look at this and like when these people put these numbers on it, like 20% drop. How are you supposed to know that?
Well, you know,
This
I can
is the same
understand.
thing as an analyst coming out there and saying something. This is the same thing as predicting an interest rate going some direction or another.
I think they were saying, I think they even said it in the video at the beginning was there's basically alluded to, it's possible it goes down 20%. Listen, whenever you have something happen, like look at the stock market. I think the S&P is worth low 2000s. Does that mean it's not going to go to 1,500? I have no idea. Does that mean it's not going to go below 3,000? I have no idea. All I know is based on history, we are very overvalued now. And I wouldn't be shocked if we saw the S&P go to low 2000s level. Okay. So 2,300, that wouldn't shock me. The point is, if the S&P went to 2,500 tomorrow, I wouldn't avoid stocks because I think the fair value of S&P is 2,000 to 2,300. I'd sit there and say, I can probably find really good deals at this value. But right now at 3,900 and 4,000, it's hard to find good deals on stocks, especially when I think stocks go down a lot further. Same with housing prices. Go ahead, Mo.
So 20% is a big drop.
For housing, yes.
I don't necessarily think it's going to drop that aggressively. I
don't think so either.
Back at 08, there was fraud going on. There was a lot of manipulation going on. We're not in that situation right now.
Yeah, I agree with that on that front. Like we don't have the same no income verification. We don't have multiple mortgages, tons of adjustable rate mortgages that are locked in for 3 months and skyrocket. We don't have the same fraud and euphoria feeling. Do we still have a lot of demand? Absolutely. Yeah. And that demand, I mean, listen, a good friend of ours owns a mortgage company. At the peak, he was doing 350 mortgages a month. He's now doing 150 to 160. Is it a big drop? Absolutely. That's a big drop. But how many of those were home refinances? He's like, we're still getting a lot of new sale mortgages.
I like the story you told about the girl. What was she's like 27 or something? And she took the 7.
Because she doesn't know any different.
Doesn't know any different.
And if you're a kid out of college and you're going to buy a house, you don't know what 3% feels like.
Oh, you never even thought about it at 3%.
Yeah. You're like, okay. And by the way, historically, mortgages should be 6-7%. It's like a terrible number.
We've been living in a zero interest rate environment where 4%. My first mortgage was 4.29%. I was like, oh, this is so much. But really, when you think about it, it's like, damn, that was pretty good.
Yeah, I have my new house.
History.
I have 4.25, and I'm like, oh my! And everybody's like, man, you got such a great mortgage. I'm like, yeah, because I locked it in freaking way before this whole surge happened. Right. So let's continue on with this video.
Notable fall in home prices, but again, specifically in the hottest markets like Phoenix or Miami. Now, on the other side, there's a dearth of inventory. 92% of people that have mortgages have a mortgage rate below 5%. Wow. Many of them are not going to be anxious to get out of those mortgages.
So listen to that.
Wow.
92% of people who have a mortgage under 5%.
That's insane.
Yes, they're only going to move if they absolutely have to move. They're changing cities or their income skyrocketed or they need a downsize. Yep. You're not moving unless you have to move, right?
Yeah.
And you're not getting a new mortgage unless you have to move. Or let's say hypothetically 10 years from now, your mortgage rate's 4.5 and rates go to 6, but your home is worth double what it was. Right. You want to pull some money out. Right. Like other than that, I mean, that's an incredible number. I didn't know that. I didn't verify that, by the way, but I'm assuming he's accurate on that one.
Mortgages and move. So the one thing that can mitigate a sharp decline is that dearth of inventory of existing homes. However, new homes, those inventories are building rapidly.
So Richard Bernstein Advisors tweeted out something very interesting to me, Peter, today, and that was, remember what happened to Texas real estate during the energy bust in the 1980s, right? We saw a real downturn there. So what is happening in Silicon Valley and those sort of formerly hot housing markets? We're seeing the layoffs begin. We're seeing a contraction in these sorts of businesses, these growthy businesses, even in the more established businesses like a Meta. We're seeing job cuts. So what happens in those markets, particularly as mortgage rates are above 7%? I mean, it almost seems like, people may...
Here's the last 5 years of housing inventory. And you saw mortgages, and then, okay, we're still below. Let's look at 10 years. Look at 10 years on inventory. Look at 25 years. Guys, we're still well below all these levels. Okay, it's like, by the way, look at this. We're below the levels of the 2000.
And I think this is where the recency bias really owns the brains of the media and everybody that's reporting on this stuff. Don't you think?
Yeah, for sure. I mean, I'm looking at this. I'm actually surprised by this.
I am too, actually.
I thought it'd be much higher compared to history. So, guys, I am not, again, I'm not here to predict the future. but I don't, to me, it's not so obvious that home prices have to fall. I'm not like sitting there going, oh my God, this is so obvious. I look at it going, all right, it probably is more likely than,
I think it's just going to be a gradual cooling off. I don't think that there's going to be a point where everybody's like, oh my God, my house dropped this much. It's like, it's just a slow trickle, stables off somewhere.
And inflation helps us.
There you go.
Inflation helps home prices.
I don't think that you're going to see this massive thing where you're like, oh my God, my house is worth 30% less than it was.
So if you've watched our other videos, if you're new to the channel, if you watch our other videos, I have no problem making a statement saying this cannot work. I'm not convinced that home prices are absolutely going to collapse. And I don't mean that to say, go buy house. I just sit there saying, listen, if you own a home and you have a great interest rate, thank you. Be happy.
Yep.
And then enjoy your life there in that home. But if you need to move, just remember that you're going to spend more money and factor that in when you move. If you're getting a job offer in another city, bring that up. It should be part of your negotiation. Like, listen, I have a 3 points. Oh, and the other thing I heard the other day, I read this the other day, back in the early 80s, mortgages were a lot easier to assume. I did not know that.
Me neither.
So that could help why prices back in the 70s and 80s still went up. Because if somebody had an 8% mortgage and the rates were 14%, you could sell your house and say, take my mortgage over.
Oh, okay.
We don't have that today as much.
Gotcha, okay.
I don't even know if I've heard of that.
I've never heard of that.
So, that's the thing. There's a lot of factors here. And by the way, back then, people would do a lot of seller financing, things like that. Because a lot more people back then, I think, percentage had more paid off houses. The whole point is, I have no problem shying away from saying, this is ridiculous. I'm not exactly convinced that this is ridiculous on home prices. And I want you to take that for two ways. One, I assess the information and not just trying to be dramatic. Two, it's about assessing the information. Like, I want to assess the information and say, listen, I'm looking at a bunch of things and there's nothing out there that really screams to me this is massively overvalued.
And when we talk about it with stocks all the time. Go back at history. Look at this. Go back at history. Look at it. That's all. Just look at the same types of data, but go back in history and look at it. Don't just look at the last 5 years, 6 years.
Yeah. You have to look a lot further.
Exactly. It's the same thing with stocks. Same thing with any investing.
So we're going to keep watching this video, but before you go, remember, we talk about stocks, we talk about real estate, we talk about businesses, we talk about mindset, we talk about debunking myths out there. This channel is a very active channel. I don't believe in just being a one type of investor. I believe in looking at money and looking at numbers and assessing it based on whether it's coming from a business, a piece of real estate, a stock. I look at it as a dollar of cash flow. Now, that dollar of cash flow can be earned and lost in certain ways, but that's why you need to subscribe. So let's keep going through this video.
Leave their homes. Who are the buyers of a home in an area where the jobs are not few and far between, but they're not really hiring at this point, and your mortgage rate is 7%?
Right. It's going to take, to your point, much lower prices. I mean, in the aggregate, housing all in is about 15 to 18% of the U.S. economy. We saw what we heard from Walmart and Target, one of the areas of weakness were things related to the home.
You know what?
And
this reminds me of something. Let's do the research right here. What matters to me most is median home price to median income. And as a country, what's the current median home value? So let's go look at this. Let's go to the Goog. So, 2020 it was 329. Okay, so here is the Fed's number. Now, I don't like this.
428,700.
That just automatically worries me. But again,
that looks like the S&P 500.
Yes, but again, we saw a major increase in what? Inflation.
Yep.
Remember, it's slower for incomes to see their way through because you're a salaried employee. You probably get a raise once a year. So it takes a little bit of time for those incomes to come through to combat inflation. Inflation just surges, costs go up. They start applying it across the board. New product, groceries are made. Look at it, for example, we have houses in Mexico. I asked them once, how long does it take a banana to get from this plantation to my grocery store? They said 48 hours. They're transferring that cost really quick. You know what I mean? So this does bother me. Don't get me wrong. But I look at this saying, okay, but it's...
When did that big spike start? Was that 20?
Yeah, that was COVID. Right after COVID.
Okay.
And that's where we saw the big increase. And I'm going to look at median home prices right now. That's the houses sold, median sales price of houses sold for the United States, $455. That seems like a lot. What's the history? So let's go back to 1990. 127 was the number. What was the GDP per capita in 1990? US GDP per capita, 1990. 23,888. So what's that ratio? 5 to 1. What is it now? 7 to 1. What was interest rates back in 1990? So let's look at interest rate, average home mortgage rate, 1990. 10%. Okay, so again, we're looking at a lot of data. Interest rates were 10%, which is almost 50% higher than it is today. And you look at 5 to 1 ratio of home price value to median income, and you look at it now and it's 7 to 1. Okay, it's not insanely off. Is it a little frothy? Sure, but if you get inflation that really kicks its head out there, it might be fine. What was inflation back in 1990? Let me look. 5.5%. Okay. Again, I wish I could just tell you right now, like Tesla's overvalued. Tesla's overvalued. Like, listen, it's a spoiler alert, but that video, like literally, just watch the video. You're gonna either love me or hate me in this video that comes up about Tesla. But
don't let your kids watch it.
Yeah, don't let your kids watch it. There's a lot of factors here, and I look at 1990 now. I'm like, okay, I could see how this is reasonable-ish. It doesn't mean that we couldn't fall, things like that, but it's not egregious to me. It's not, the landscaper makes $7 an hour back in 2006, getting $1 million mortgage to go flip houses. I remember idiots telling me like, Paul, I used to go in the bank and ask for a credit line to buy homes in the ghetto, and they'd give me a credit line same day for $500,000. And I'm like, what? Those kind of things aren't happening today. Yeah, when I have to jump through hoops to get a mortgage, which I had to, I remember going to my banker going, what the F are we doing? He's like, this is the new regulation. It tells me that the lending side is tighter than it used to be, which I'm okay with. I'm happy about. I just look at these things thinking inflation, mortgage, it doesn't feel like it's insane. Now, was the demand crazy? Yeah, but inflation could really save the day for people. So that's the video. Please subscribe to the channel. Remember, we do businesses, investments, real estate, stocks. We bust myths, all these things that we do on this channel. It's everything about money. You're going to love subscribing. You're going to learn stuff every single day. Thank you very much. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?